Nikhil Vora, Managing Director of IDFC Securities, joins us live. Nikhil, got to start with the new trend, and the new trend is that consumer stocks are also coming under pressure.
It shouldn't really be very strange in this. The fact is that the polarization of the market has been so acute that we are seeing literally all-time highs and all-time lows being created pretty much simultaneously in the markets right now. You look at the consumption space right now, it's getting valued pretty much close to what it used to get valued in 1995 when there was literally no other option to consumption. It's getting valued as if consumption today is 1/3 of the Indian market, which it is not, which it used to be in 1995. And clearly, the fact is that growth rates right now are at single digits compared to double-digit growth that you saw it during that period of time. So I think there is clearly the polarization for growth, which has become extremely acute, and it is but natural that some of this over investments in consumption will give way. Part of it is also to do with the nature of polarization within consumption basket. Levers had an event calendar, and that literally led to some bit of overcrowding in levers. ITC also pretty much the only player which continues to grow over 15-16% right now. So I think that has to get slightly more released out. So I think it is somewhat expected. Growth rates are likely to be in the 5-6% zone as we move forward, and there is a very limited rationale to pay value which we've been paying till now for consumption, given the state of the markets, which seems to be totally falling apart.
Nikhil, hi, morning. So do you think growth will remain with names from the IT pack at least, wherein the currency denomination as well as the US recovery seems to be working in their favor?
Well, the fact is that, the irony is that Indian market have very, very rarely been a value market. It's always been a growth market, and invariably, we as investors have always tended to pay a lot more for growth than value. Growth rate, albeit at a lower level, still seems to be slightly more visible in businesses like IT, pharma, consumption, a bit of oil and gas. So I think, as long as that level of growth continues to remain visible, we will end up paying a slightly more higher value for a suboptimal growth. IT clearly does stand out right now, purely because you are playing a developed market proxy through IT right now, and you're also playing emerging market weakness through IT, which is again the dollar appreciation. So I think IT could continue to remain possibly a protected sector for some time right now.
Do you think the large cap IT space is getting slightly crowded? Just about everyone is bullish on large cap IT stocks. Most of the large cap IT stocks, with the exception of Infosys and Wipro, they are marching towards new high. Do you think it's a matter of time that this crowded trade will get challenged? Because seldom I've seen that crowded trades don't last long.
There's this interesting saying which says that when you are in a slump, it's no great fun. Unslumping yourself is not easily done. So clearly, it's a challenge to reverse the trend across broad markets that we are in. IT as a pack right now it's fairly insulated from that sort of a pain that one is looking at. Having said that, I've seen little merit in generic in markets to be extremely polarized, irrespective of the way the near-term or the mid-term market looks like. So I think the more the polarization, the greater the risk as you move forward, which you're starting to see a bit evolve in consumption. So if you look at consumption pack, they are down by around 15 to 20% right now from peak. Not terrible considering a lot of other market stocks, but still 20% off consumption is a fair bit. IT is getting into that zone, but it is still into a period where valuations are not getting extremely rich and demanding. So I think for some time maybe IT can provide the rear guard right now.
What about banks then, Nikhil? Will they tend to be at the lower end of the market hierarchy?
Well, if there was one big concern right now in corporate India, which is how do you really kickstart the economy and whether there are adequate private sector who's willing to play that role, I think that reigniting investments is the biggest challenge because the existing investment is into significant strain. And I can say that with some certainty that right now private sector investment appetite is pretty much at possibly the lowest ebb that you would have seen in the last few years. The current investments are pretty much over-leveraged and demand curve is pretty much non-existent, which means that the strain for financials will likely continue over the near term. For the first time, you're also starting to see banking sector as a whole starting to exert a lot more pressure on their existing disbursements. So you've seen a fair bit of corporate group get into strain, and my sense is that if you start to look at interest rate looking to harden up or remain where they are, and maybe a quarter or two of demand pain continuing, I do think that you will see disproportionate pain still being there in financial sector because lot many of corporate groups in India which are over-levered are bound to get restructured, refinanced, and maybe at some point also get classified as NPAs. So I think financials are in for strain, unlikely to change in the very near term, which could be the next 6 months or so. And I think till the time you don't really see monetary policy really reverse track and corporate India sentiment start to improve, I don't really see too much of merit of investing in financials right now.
Markets always look forward. How much of the pain is already in the price? Because when the turnaround will happen, the stock prices would have turned around before the absolute reality.
I am not too sure whether really you'll see a V-shaped recovery from here on. I think the fact is that you've got into a structural, a lot of the malaise that you look at today is self-inflicted in some sense, and that's unlikely to change in a big hurry. We've been sensing this out for the last 6 months odd, where our sense is that, investors may as well as remain on the sidelines. This is not the market of 2008-9 where you saw extremely sudden spike and reversal. My sense is this is a gradual pain market. And like I said before, if markets show you an all-time high and all-time low at the same point, you've got to worry a lot more, which is what it is. So I would much rather for once play on the sideline, not really indulge too much, not as a trader, not as an investor. Either side, I think it's becoming extremely, extremely difficult because the visibility of businesses is getting extremely murky. And give or take 5 to 10 stocks in the Indian market right now, which might still continue to show a decent sense of back-ended growth. I think the broader markets are not. And valuations in that 10 stock bucket is pretty much at levels which are possibly taking the next 2-3 years of growth into account. So my sense is that we may as well as play the reversal when you start to see the first sign of changeover, rather than now preempting that changeover. So we are pretty much cautious, extremely cautious, and rather do think that investors in generic will get a much better entry point in the Indian market.
Well, you're not cautious, you're bearish. That's what you're trying to indicate.
It's always a struggle to be more bearish in India because after a point in time, people get fatigued out of bad news. People get used to playing along the lines and possibly play with the limited capital that they end up having. Obviously, I'm bearish. I'm cautious right now, and frankly, a lot of events which have happened in the last few months just possibly furthers that view. You've seen some bit of demise of entrepreneurship in India in the last few months to a year. You've seen the first bit of restructuring in a big way happen in, let's say, Future Group by Kishorji. You've started to see a fair bit of pain in say Educomp. You've seen obviously the recent pains in financial technologies. So I think a lot of entrepreneurship is at the back burner right now. So the risk-taking appetite of corporate India will surely take a fair bit of backstop. And whenever you take risk appetite off the system, you've got to expect a more granular and gradual growth rather than extrapolated growth, which you saw earlier. So I'm getting extremely cautious. I have been very cautious in the last 6 months and really don't see any major reason to change that stance right now.
Okay, fair point, Nikhil. Good chatting with you as always. Appreciate you taking the time out and speaking with us.